Hi everyone, good evening. Thanks for joining us on our webinar for today. So before we start off with today's webinar event, just would like to check, can you all see my screen right now? If yes, maybe can you type 1 on the chat box so I'm aware that you all can see my screen? Okay. Okay, all right. So before further ado, firstly, I would like to introduce myself. So I'm Chawi, a senior dealer in Phillip Capital Senyap Berhad. So it's very honored to have all of you here to join us on our webinar today. Okay, so before we start off with today's webinar, firstly, I would just like to make a brief introduction on our company background. I promise it won't take long. Okay, so before we start off with today's event, just a disclaimer that today's presentation is solely for educational basis. So before, if you all like to make any financial decision or any trading decision, please seek advice from qualified financial advisors before making any commitment to purchase any investment products. Okay, so without further ado, let's begin with today's introduction. So to briefly let you all know, Phillip Capital Senyap Berhad, our company is actually incorporated on the 7th October 1995. So our company is a wholly owned subsidiary of Phillip Capital's Holdings Senyap Berhad. And previously, you all might heard of us known as Phillip Futures Senyap Berhad. But over the years, we have actually changed our name to Phillip Capital Senyap Berhad. One of the reasons is because right now, our company today, we are able to offer more products to our clients. We are able to offer stocks, broking services, CFD, ETF products, and also derivative products to our client. Okay, so for Phillip Capital Senyap Berhad, you can know us as a trading participant of Bursa Malaysia Derivative Berhad. We are also a holder of Capital Market Services license and also a participating organization of Bursa Malaysia Securities Berhad. Okay, so you can actually locate Phillip Capital offices all across Malaysia. Our headquarters is actually located in Kuala Lumpur. We have up to 11 branches, which we call it as Phillip Investor Centers. So no matter which state you are from, we actually have a branch and also staff to serve you and also assist on your request. All right. So Phillip Capital, we also have very wide global network. We have partners all across France, UK, US, Malaysia, China, Japan, Australia, you name it, we have it. So this is one of the reasons why we are able to cover a very huge global products all across the globe. We have products like ICE futures, European exchange, product from European exchange, products from Hong Kong Future Exchange, Stock Exchange, Osaka Exchange, Singapore, Australia, and also all those US products. All right. So recently, Phillip Capital, we also have been awarded as one of the top 1 choice brokers. We are champion in best retail derivative trading participant and also second runner-up for best overall derivative trading participants. Okay. So our company, we are actually aiming to become a one-stop solution for your trading experience. So right now we are offering products like I mentioned earlier. We have futures products. We have index futures, agriculture futures, metals, gold, energy, interest rate futures. We also have stocks. We offer products like Malaysia shares, US shares, Hong Kong shares, Singapore shares, Australia shares. And upcoming, we also will be launching China A stocks as well to our clients. We also have products like CFD. We cover Bursa Share CFD, New York Exchange CFD, Nasdaq CFD, and also US Index CFD. All right. So one of the question you guys will ask is why you would choose Phillip Capital as your broker house. One of the reasons is really been in this industry for quite a long time. We have won multiple winning awards as a multi-asset broker. We have dedicated 24 hours stockbroking and execution support, which can assist on your trading experience. No matter you're trading on the night session, London session, or UK session, we have a 24/7 dealer that will be here to assist you. We also have advisory service. We share latest market news to our clients, and we also offer very wide array of products that cater for your trading experience. And most importantly, we do not charge any platform fees if you guys are trading using Phillip Capital products. Okay, so from time to time, Phillip Capital, we also offer our services to our clients, where if you are new to trading, we do offer introduction to futures, CFD, and also stock trading service, stock trading webinars. We also offer product knowledge, platform coaching, and also from time to time, we also have charting system technical analysis that we share to our clients. So for those of you who are actually interested to learn together with us, we actually have weekly market calls for every Monday, 11 a.m. Our Phillip Securities Research team will present on their weekly views on what's going on with the global market. And we also have our analyst, Zain, who will be here to share his technical analysis on a weekly basis, which falls on every Monday, 8 p.m. So if you guys are interested, you can actually head over to our website. The details are displayed over there. And if you guys are interested on what's going on with our upcoming seminar and webinars, you can actually scan the QR code over here to register for our upcoming events. All right. So for those of you who are interested to open an account with us, you can actually scan this QR code over here. We have stocks account, futures account, and also CFD account, which we does not charge a single cent on it. All right. Okay, so here we'd like to brief you all what kind of trading platforms Phillip Capital is actually offering right now. So for those of you who wants to trade derivative products, we have our own house, Nova, which you can actually scan the QR code over here to apply for a demo account. So our Phillip Nova we actually uses trading view charting system, which is much more user friendly to our clients. So over here, you can actually see that you can actually trade both local and foreign products in one account. We have up to 17 global exchanges products that are available for you to trade on. Moving on, for our stock platform, we have our own in-house app as well, known as the Poems Global 3.0, which we have all-in-one watch list, charting indicators, powerful stock analytics that you can actually use for your fundamental and also technical analysis. So right now, you can also invest US shares and ETF from only 0.02% or minimum USD 3.99 by using our Poems Global 3.0 platform. As for those who wants to trade CFD, we also have our own in-house application known as Phillip CFD Trader, which is very user-friendly. We have live charting and also price alert, live market price that cater towards your needs. So right now, Phillip Capital, we also have ongoing promotions to give back to our clients. So one of the first promotion we are actually having is for our CFD clients, where you can actually enjoy trading US share CFD with zero commission. The event date is is actually running from September, and it's going to end on the 30th November 2025. Okay. So for those of you all interested, you can actually scan the QR code over here. But if you guys miss out on it, you can actually head over to our website, phillip.com.my. Everything is done updated over there. So for those who are interested to trade on shares, we also have another promotion for our shares platform, which is Go Global with Margin Financing, where we only charge 6% per annum for 6 months. So for those new users, you are actually entitled for free RM100 touch and go reload pin. We have special interest rate, zero rollover fees, stamp duty reimbursement, and also free access to global markets. Okay, so for those who are interested, you can actually scan the QR code below. And as for our derivative campaign, right now we are actually having BMD campaign, drive your BMD trades further with Philip. So for new account opening users, you are actually entitled for RM50 account opening bonus. Yes, you stand a chance to win electronic gadgets such as brand new iPhone, iPad, AirPods. And our grand prize for this campaign is a Perodua MyV, where the more you trade, you stand a chance to win prizes such as MyV and all these electronic products. So for those who are interested, you can actually scan the info over here to learn more about the campaign. Okay, so without further ado, today we are very honored to have Mr. David here to brief us on what's going on with the Malaysia market today. So I think I'll pass the floor to Mr. David for him to introduce himself.
Okay, hi. Thank you,
David, are you
Joey.
here?
Yes. Yeah, can you hear me?
Yeah, can hear you very clearly.
Okay, yeah, sure. Just allow me to share my screen.
Okay.
Yeah, are you able to see my slides?
Yes, can see very clearly, Mr. David.
Okay, yeah, sure. Okay, thank you very much. So thank you very much for the very kind introduction, Joey. And also obviously thank you for Philip Capital for inviting me today to talk on today's topic, regards to FKLI futures. FKLI and FCPO, there are two major futures product that is available in our Malaysian market. These are the most two actively traded product that's in the market. So I think Malaysia performance as an index itself has actually been quite volatile this year in particular. We have seen how the index actually performed quite badly in the beginning of the year. Then slowly in the last few weeks or months, we saw that the index actually pick itself up. So I think in today's session or tonight's session, we'll probably be talking about what factors that actually influence the index performance, or factors that actually affect FKLI. And obviously, in the second part of the session, we'll be talking more on looking at things more technicality and how do we create a so-called trading plan that we can use to navigate the market, especially during these volatile periods. So just a usual risk disclaimer, I think any material that's presented here today is purely for educational purpose. So any opinions that you're hearing is purely based on my own, doesn't reflect any opinion for this from the exchange or whether it's from Philip Capital. So if you are new to futures, if you are first time hearing into a futures seminar, make sure that you know that dabbling and dealing in futures or market is a derivative instrument. So the risk that's involved is highly leveraged. So make sure you are well equipped, well informed. I believe you want to find out more information. You can always speak to Philip Capital representative. They are more than happy to help you in this area. So these are what I'm going to cover. I think four key major points. First thing is to look at how can we what are the factors that actually affect FKI performance, and really how, if you just look at index or index in general, factors that usually affects it are usually the economic performance of the particular country. So in Malaysia context, if we want to look at where FKLI is going, also we need to understand and assess how the Malaysia economy is performing as a whole. Now, external factors are also important. Later on, we're going to discuss what are the external factors. Now, keep in mind, Malaysia is still a very commodity-driven economy. So that means, CPO prices, oil prices, all this will have an important impact, especially oil, because we are a very oil major exporting country. Now, if you look at, I'm a big fan of seasonality. Seasonality, the word of caution is that doesn't mean that every year we see this type of pattern, this pattern repeat itself this particular year. There's always bound to be a period where markets doesn't always follow a previous seasonality pattern, but there is certain tendencies that we can gather. So if you are trading or you're observing the market, be very careful that imagine if you're going into a period where index tends to perform very well in the next couple of months. Then you shouldn't be looking for a short position, rather than you should be looking for a long position. So these are the kind of things that we tend to observe, and we should be monitoring quite closely when it comes to seasonality impact when you talk about the KLCI performance. Now, last but not least, I think I'm going to cover a little bit on how do we use technical trading strategy to navigate the market, especially you talk about trend. Now, there's many ways to trade the market. The two major ways are looking at trends. Another way is looking at mean reversion, where if a certain trend has oversold, overbought, or whether the market is in range, there's no clear trend. So there's only two styles of trading. So I'm going to share more of using trend rather than looking at markets when it's being in a range trading strategies. Now, year-to-date performance, I think KLCI, I think it did pick up in the last couple of weeks or months, but year-to-date we're still down over 2%. Now, in this region, Vietnam and Philippines are doing very well. I think Vietnam in particular, they're almost up by 50%. Now, this is driven also mainly by China and US trade war that's happening. So a lot of trades are rerouted to Vietnam as a hub, and therefore the economy actually expanded quite tremendously. Now, and that also reflected by their index performance as well. Now, I think even Singapore is not too bad. Year to date, they're up by 16%. Indonesia as well, up by 15%. So KLCI, hopefully we can close the year either marginally or marginally higher. But I think right now we are trying to close up the losses that we've seen year to date performance. Now, this is where we are. You look at technically, we are trying to hold above the 1600 mark for the KLCI. Now we have surpassed the 1500 and we hold above that level quite significantly and quite for a long period of time. So holding above the 1600 will be quite crucial. So anything that breaks below 1600, technically that could be a psychological level. So once we break the 1600 again, that tells you that the market is actually quite bearish. But we are still holding well above the 1600. So hopefully towards right now, 2 months into a year end, right until the end of December, hopefully we can still see index continue to trade well above the 1600 mark. Now, when it comes to Malaysia economic performance, one thing to take note of is that GDP has actually slowly been improving. We can see that it's across many sectors. Agriculture is actually one of it. Even I think manufacturing tends to slow down a bit, but construction services actually did pick up quite tremendously. So GDP-wise, Malaysia can consider fairly okay. I think the latest third quarter numbers seems to show that's a positive sign. So therefore, I think Malaysia, you look at where the index performance is also holding very well, holding above the 1600 mark. So GDP performance in terms of Malaysia GDP economic activity seems to be robust, and there's no sign of any weaknesses across some of the major sectors. Now, if you compare US and Malaysia market, it's very two very big contrast. Those days, if you trade the Malaysia market, normally we can always rely on observing both the US and Malaysia market. Right now, you can see that Malaysia is really on its on a different path, and the US market is literally on a different path. Now, US market is literally on all-time high basis. S&P 500, even Dow Jones, they are continuing every day on a daily basis hitting all-time high levels. Malaysia is yet to reach those levels. But you can see that we can't draw a strong relationship between these two markets anymore. US is running on its own economy, and I think recently with the trade, now they're talking about easing of trade tension between US and China. That will propel the US index to even higher levels. While Malaysia, on the other hand, we are plagued by many other problems, not only domestically or even in external problems, but I think because of that, our index find it difficult to really go to a certain level. So we can't really draw a comparison anymore, comparing between the US market and the Malaysian market, just for the fact that both these economies are actually running on a different level. Now, if you just look at US market, a lot of people say, hey, can the all-time high be peaked soon? It's actually quite unlikely. Now, why is it unlikely? If you just look at this chart that I have here, this is looking at margin debt. Now, what margin debt shows is that it's an amount of debt that's being taken by consumers to buy stocks. So obviously, interest rates are expected to come down. So interest to pay those debts are also, the cost of paying those debts are also coming down. So therefore, as long as the index or the stocks are perform robustly or perform well, stock prices going up, generally you see margin debt keep increasing. Now, normally if you look at when margin debt starts to decrease, that's where usually be a sign that a lot of people are lacking confidence in the stock market. So therefore, a lot of people will tend to try to close up their margins, sell their stocks, and to repay those interests. So right now you can see margin debts are actually at almost quite an elevated level. So it still shows that there's still sign of growth in terms of the index performance for the US market in particular. So the euphoria is still not peaked yet, but be careful. Watch out on the margin debt levels, especially when it starts to peak and starts to come down. That usually be a sign that I think people or general investors' confidence are starting to diminish and a lot of people want to sell their stocks and probably cover up on their loans. So that's margin debt is one good indication as to when probably the market, the stock market may peak in the US especially. Now, as you know, Malaysia is a very oil-driven economy, so oil prices are a very important factor for the Malaysia economy. So currently, oil prices are languishing on the level below $60 per barrel mark. It's doing that level because you look at where the supply and demand for oil is. OPEC is very OPEC being OPEC, they're actually quite bullish. But if you look at other reports or other oil reports, they're actually quite bearish going into next year. Is because you just look at despite you're seeing strong performance in stock market, but the general underlying economy is still seeing slowdown. So with that happening, the demand for oil journey will be quite weak. And supply remain quite the output remain quite strong in the sense that OPEC decided not to control supply because they think that if they control supply too much, despite you can see higher oil prices, but sooner or later they'll lose their market share to the US market, which is also a major oil exporter in the world. So I think oil journey is going to be quite weak, or it's going to play range bound between the $55 to $65 mark. Now, generally, when you have low oil prices, it's generally not a good thing for Malaysia economy because we are quite an oil-driven economy per se. So because we are oil exporting country, so if you just look at this, it will put a weight and it will definitely put pressure on how the KLCI is going to perform going forward. Now, this is where it's being forecasted. I think that's why going into next year, we can't be too bullish because the oil revenue is expected to decline going forward because oil prices are just not going up, bearing for any unforeseen circumstances. And usually if there's geopolitical crisis or geopolitical tension, you see oil price spike. But bearing those situations and those circumstances, we still think that oil prices is going to be quite weak going into 2026. And because of that, a lot of analyst reports has been stating that oil revenue coming especially from Petronas going into next year is going to be quite limited, or it's going to be slightly on the lower end, and that's going to put pressure in terms of how the government is going to raise revenue to do fiscal spending and whatnot. So these are all what have a major impact in terms of how the index performance is going to behave. So given the underlying economy next year is going to be quite challenging, the FKLI performance will definitely be something that to be weighed down, especially when economic performance are not doing that well. Now, not only I think in terms of oil revenue that is slowly shrinking, we also have debt and contingent liabilities that's also gaining higher levels. So really, I think in terms of economic landscape, it's going to be quite tough. We are easily influenced by external factors. If external economy, especially the world economy, is not doing progressively well into 2026, it's going to have definite impact on Malaysia. Now, internally, domestic economy as well, we are facing higher debt servicing levels, and also we are surpassed debt service charges. That's the limit that we have set for ourselves. So with all this in mind, is definitely going to put a lot of pressure when it comes to governing the domestic economy. Now, and with that in place, it's going to be very worrying as we go into 2026. How the government is going to navigate through all these treacherous high-level debt position and also high debt servicing costs. So this is something that we really have to look ahead. If you're looking at how the index performance is on medium to longer term basis, all these factors, economic factors, will put a weight on the index performance as a whole. Now, besides looking at oil, besides looking at internal domestic economy, I think ringgit currency factor is a one good indication as well. If you look at how the index performed with regards to ringgit, the ringgit strength. Normally, when stronger ringgit, that means there's more fund flow coming into the country. There's more demand for the ringgit, and in general, that will mean a stronger index performance. So right now, again, ringgit performance against the US dollar is actually quite robust between the 420 level, and it has been holding there. So we have seen how the rise in strength in the ringgit over the past couple of months, and that actually helped to propel the index going into higher levels. Now, whether that can sustain or not is still much to be seen, given the fact that there's still many uncertainties ahead now, and and ringgit. If you look at the relationship, is whenever you have a weaker ringgit, generally that's not good for the index as a whole. So stronger ringgit, that means there's more money inflow coming into the country demanding more ringgit, and when there's more money outflow, you will face a weaker ringgit, which means the index will actually be affected as well. Now, I think one of major important parameter besides looking at domestic variables, the external variables actually when it comes to foreign shareholding or foreign inflow is very critical for Malaysia. Now, a lot of people will say Malaysia is a very restrictive, or I won't say restrictive, but it's a very and there's not much participation from foreign players. So therefore, it's a very in a very closed circuit market. But if you look at the numbers, really you can see there's an ongoing downtrend in terms of foreign shareholding for the past couple of years. Now, if this continues, that means the economy itself is only very domestically driven. Now, foreign shareholders are important because when your economy is good, when you attract foreign interest, generally that your market is actually more robust, and therefore your index as a whole will actually perform better. Now, when foreign shareholding starts to diminish, that's going to be a concern because there's more outflow going out of the economy, and that usually means that generally the index will find it very tough. So this chart, what we have here, if you just compare KLCI performance and foreign shareholding, you can clearly see that when foreign shareholding starts to accelerate back in 2018, on a downtrend, you can see that the KLCI FKLI performance or KLCI performance actually gradually starts coming down. So foreign shareholding is a major factor that can really drive the index performance. Now, without these foreign shareholders coming into the picture, it's actually very difficult to see our our domestic market perform very well. So you really need the foreign shareholders of foreign interests to come into the market to support the market and in a way to propel the market to higher levels. Now, here comes the seasonality chart that we have for FKLI over the past 5 years. So you can see if you break down from January to December, you notice that when it comes to year end, October tends to be a bit mixed. In fact, it's actually quite a negative month for the month of October. Over the past 4 years or so, there's only one. So far, we have this is the year that October tend to record very well. So let's see whether if you go into November, December period, normally you see even stronger levels for the FKLI based on the seasonality pattern. So really, if you look at over the past 5 years, December seems to be a very strong month. Whether it's because of window, it's the year end, so it's window dressing period. Whether you can attribute to the fact that because of the window dressing period, index tends to close positively. That could be one reason, or there could be various other factors as well. But if you look at it, January year end towards the fourth quarter, index actually tend to do very well, with exception of October. Now, October, over the past 4 years, actually been a negative month, but we are only 2 days away from the end of October. Looks like the index seems to do better for this particular year. So, like I said, seasonality doesn't mean that based on previous pattern, this is the pattern that we notice, or this is the pattern that we realize. There's bound to be a year where this particular pattern doesn't seems to follow. So these are the things that we really need to understand when it comes to seasonality, because there's usually bound to be a period or bound to be a particular time where it doesn't really follow the past seasonality. So these are the things that we really have to be careful whenever we look at seasonality patterns. Now, if you are new to futures, so FKLI stands for the futures contract based on the the KLCI index market, or the FTSE Bursa Malaysia Kuala Lumpur Composite Index. So every 1 point is 50 ringgit. So it goes on a multiple or incremental of half a point. So half a point is 25 ringgit. So just to give you an insight, the trading hours is very different from stock market. If you're so used to stock market, futures market usually opens 15 minutes earlier. So it's 8:45 to 12:45. Then the afternoon trading sessions is usually 2:30 to 5:15. Now, in futures market, recently the exchange also introduced the T+1 session, the after hours session, which usually from 9 p.m. to 2:30 a.m. Now, after hour session, sometimes the volume are actually very minimal, but Having this after hour session can be also quite useful, because in futures you can do a long position, you can also do a short position. If you are having a negative view of the market, you can always short the index performance. So having an after hour session where it usually coincide with US market opening or even European market opening, when they starts to have a serious movement in the market, you need that session to actually place or position your portfolio. If you don't have that session, sometimes you can get caught off guard. So having that session is actually quite useful in a way that it helps traders to probably better manage their position. Obviously, liquidity can be an issue because the participation usually at the night session could be quite low. So that's so-called a bit of drawback. But having that window, that session window, and trading on the US market timing is actually quite good if you are trading. If you're holding a position in FKLI, where you can able to either close a position or engage a new position during those times. So it's a cash settlement contract. It's not a physically settled contract like CPO. So in a way, you don't have to worry at the end of the last trading day. If you have not done anything to your open position, your broker will be kindly enough to cash settle and put the remaining balance back into your account. So FKLI is lesser risk of answering a physical settlement as compared if you do FCPO, it's a physical settlement contract. Now, just to show you the volatility of FKLI right now, you can see that despite the big sharp drawdown back in April where the US started the liberalization day, since then you can see volatility has actually been shrinking. Between the range per day is about 15 to 20 points. At the peak during April, we saw during the time it went to as high as 30 to 35 points per day. But since then, volatility actually starts to decrease. So, if you are new to futures market and you want to try futures trading, FKLI is actually a very good product to trade to start off with, because the nature of the volatility is actually very low. Okay, moving on to the second part of the session, talking about technical trading plan. So when you want to define a trading plan, it's always important is that if you are looking at trends, there's many ways to identify trends in the market. You can look at trends using moving averages, or you can just look at the trends visually, whether it's uptrend, downtrend. You can see whether the highs are getting higher or the lows and lows are getting higher. So generally in an uptrend, you see the high and lows are going higher. Downtrend is vice versa. You see the high going lower, the lows are also getting lower. Now, if you are trend trading and the markets are moving side range where the high and lows are equal, there's no point to do trend trading, because the market is moving sideways. If you do trend, if you use trend trading strategy, usually it's very difficult. So trend trading usually applies when markets are trending. So how do we spot markets are trending? Like I said, you can use moving averages, or you can look at it visually comparing the highs and lows. Now, another way to look at trends is to use what we call Heikin-Ashi candles. Now, Heikin-Ashi candles is some sort of Japanese candles, but Heikin-Ashi takes into account the middle of a Japanese candle bar. So in the sense that it removes a lot of extreme movements. So it's just represented by taking the average of the bar. So by looking at that, sometimes you can spot trends quite easily using Heikin-Ashi candles as compared to using Japanese candlesticks. Moving averages is one good trend tool as well. So you can pair that moving averages and Heikin-Ashi. You can get quite a good entry and also exit signals from there. Now, I also if you look at trends, DMI or directional movement index is also one great trend tool that you can use to actually look at trends in the market. Now, DMI, later on I'm going to share with you what is DMI and what are tools available under DMI indicator. But I think most important under DMI indicator is to use the ADX function. Now, the ADX value is part of the DMI indicator, and this ADX value gives you an indication as to whether the trend is gaining momentum or whether the trend is losing strength. So once you identify a trend, you need to know whether the trend will continue. If it doesn't continue or is losing its strength, there's no point to be taking that particular position as well, because you don't want to be taking a position when the trend is almost ending or it's almost the tail end of the trend. So you want to be taking a position when the trend is just probably going to starting or gaining some momentum. So ADX value or ADX indicator, which is part of DMI indicator, gives you that kind of specific advantage. Now, setting profit and target and stop loss levels is very important, especially stop loss. So in any trading plan that you use, you must have a way to get yourself out. Stop loss levels is very critical. So a way to measure your stop loss or to get yourself out from any situation is to use ATR value, which I'm going to share with you later. Now, so you can see that, the 1700 mark is another strong resistance we have seen. We have not surpassed that, or we haven't even touched that level yet. Right now, it looks like we are still striving to hold above the 1600 mark. So you roughly know where the range is. The wider picture is 1700 is always a resistance. 1600 seems to be the short-term support for the market at this current juncture. Now, so I mentioned earlier ways to determine trend in the chart by looking at the highs and lows, comparing the highs and lows and the lows. So higher highs and higher lows normally is an uptrend market. Lower highs, lower lows is a downtrend market. So if the highs and lows are equal, that usually means it's a range market. So range market, you have to use a range trading strategy, and you can't use a trend trading strategy. Now, what I have here is two different type of candles, but it's the same instrument, same time frame. The only difference is the type of candles being used. So if you look at it, if you try to identify trends in the market, chart B, which is usually the Heiken-Ashi candles, it can distinguish trends in a better manner as compared to chart A, which is your normal Japanese candlesticks. Because if you look at it, the series of green and red, especially when you look at it, is on the Heiken-Ashi chart, is showing you still red candles, but on the Japanese candlesticks, it's telling you a red series of red and green. When you see that kind of series, you're not sure whether are you in a trend or is this trend going to end. But when you have Heiken-Ashi candles, it helps you to identify whether that particular section or candle bar, is it still in an uptrend or a downtrend market. So for a trend, for the trend trading tool, Heiken-Ashi is a very great tool or great candle to use, especially you try to identify trends in the market. Now, Japan's candle, the only, I wouldn't say it's a disadvantage, but the only difference that you need to realize is that when you use Heiken-Ashi, the gaps are represented by the bar, the candle bar itself. So you can't really see gaps when you use Heiken-Ashi. So if you are using gap trading strategy, or you want to see gaps in prices, you have to convert your Heiken-Ashi back to Japan's candlesticks. Other than that, for trend identification, Heiken-Ashi is actually a better tool as compared to using Japanese candlesticks. So I'm not going to go too much on introducing Heiken-Ashi. You can get nowadays with the internet, you can search many information on Heiken-Ashi. In fact, I think there's a fixed formula, or there's a fixed formula that actually calculate the value of Heiken-Ashi. So if you are doing automated programming or automated trading, you can actually incorporate the formulas into your particular formulas, trading formulas, and you can actually preset Heiken-Ashi into your trading strategy. So in the sense that it can actually be automated as compared to Japan's candlesticks. You try to automate, it's not so simple. So Heiken-Ashi, because of that nature, is also widely used by a lot of automated traders who use it as a way to program their trades by looking at the Heiken-Ashi chart. Now, why is it so popular, especially when it comes to trend markets, is that it helps to identify to you, or helps to distinguish clearly to you what are the trends of the market is at that particular point in time. So, and it's very intuitive. Whenever you see a green candle, that tells you generally the market is uptrend. Red candles, downtrend. If you see a series of green and red, very small body, or almost like a doji, you can't see any body, that means the market is sideways. There's no trend. So, during those times, you cannot do any trend trading strategy. You have to wait for the next signal. So because of that, it's actually very simple. And one of the key things is that if you look at it, Heiken-Ashi is only talking about 3 distinct patterns. Now, Japan's candlesticks talk about 100 over patterns. So to really master Japan's candlesticks, you really need to go through many multiple charts. Heiken-Ashi, you need to talk about 3 simple patterns, and that's all you need to know. So like I mentioned, the only major difference, is the price gaps. So Japan's candlesticks shows you the actual price gaps, but Heiken-Ashi doesn't. So in a way, if you want to look at the price gaps itself, you really need to convert back into Japan's candlesticks from Heiken-Ashi chart. So these are the 3 distinct patterns. As long as you see a green candle with upper wick, that tells you the momentum is very strong on the uptrend level. If you see a red candle with a bottom wick only, it's telling you that the downtrend is very strong. Now, if you see colored candles with upper and lower wick, generally that tells you the momentum is the uptrend momentum or downtrend momentum is losing strength. Normally those indications is that the market probably be taking a break, or the trend is slowly picking. And the third type of pattern that we need to be very careful is that when the body is actually getting very small, normally that tells you the market is heading to no direction, and during that time market is usually sideways market. So in sideways market, if you try to do trend identification, it's not easy. So just to give you the dynamics of it, these are basically the red color candles. You can see that strong red body candles with only lower wick, telling you that the downward momentum is actually very strong. Vice versa, you start to see green candle body bars with only upper wick, is telling you that the upward momentum is actually very strong. Be careful when you start to see doji or small body candles. It's just telling you that the market trend is slowly fading. Market is moving sideways. So if you try to look at trends, it's not going to be easy during that period. So just to put into context in FKLI, you can see that series of red candle body bars, lower wicks. This is just generally telling you that the market is heading downwards. Then a series of green colored body bars. Although certain candles are very small, but as long as, that's why we need to pair it with other trend tools like moving averages to tell you whether this. If you just look at purely on candles to trade based on Heiken Ashi candles, it's not going to be easy, because certain times when you start to see almost doji style, especially during uptrend, you'll be thinking, hey, is this the end of a particular uptrend? So you really need other tools to help you, to aid you with example like moving averages or the DMI indicator as a way to help you to manage those positions or those situations. Now, so like I mentioned, Heiken Ashi itself alone is not sufficient. You need to pair that with moving averages. So we have obviously two types, simple and exponential. So a lot of people will prefer exponential moving averages, the type of moving averages, because it actually closely reflect the price or envelop the price movement quite closely as compared to simple moving average, where it actually takes some time. Now, keep in mind, moving averages are still a lagging indicator. So it actually takes the average of prices. Once the prices are being out, then only it starts to calculate. So, but having said that, exponential tends to give more weight on the recent price. Therefore, the movement of moving average tends to reflect better as compared to simple moving average. Now, moving averages are a very great tool, because if you see prices above the moving average, generally that tells you that this market is an uptrend market. If prices are below the moving average, just that generally tells you it's a downtrend market. Now, the second function of moving averages is to also act as a support and resistance. So moving averages often act as a dynamic support and resistance. Later I'm going to show you how and why is it so. Because a lot of people are mistaken that moving average is all talking about whether price is above the moving average or price is below moving average. So it's not only for trend directions, it's also for support and resistance. Now the third function is also looking at crossovers. So crossover signals are very simple. You need a shorter term moving average with a pairing with a longer term moving average. So normally in my examples that I showed to you later on, the shorter term will be a 9-period EMA, and the longer term will be a 20-period EMA. So whenever the shorter term crosses above, that usually means it's a bullish crossover. So generally that means prices are going up. And if the shorter term crosses below, that usually means the market is heading downwards. It's a bearish market. So that's how we work. That's how we use moving average for crossover signals. So there are three major functions. One is for trend direction. Two is for support and resistance. Third is actually for crossover signals. So this is how we apply. So you can see that we have two different time periods for moving average. We have the shorter term and the longer term. So the red one is a 9-period EMA. The blue one is a 20-period EMA. So first you have the red Heiken Ashi bars. It starts to shows you that's a series of red Heiken Ashi bars, and the bars are below both the moving averages. So it's telling you that the market is heading for the downtrend. Now, bullish crossover happens when you can see that the series of green candle bars are forming above the moving averages. And notice that this 9, the red color line, the 9 EMA is acting like a support for the movement on this uptrend. The moment when it starts to appear, the red Heiken Ashi bars, it break it, it's telling you that this short-term uptrend has actually turned into a downtrend market. So in other words, this moving averages is acting not only for trend direction, not only for crossover, it's also acting like a dynamic support for the candles itself. Same goes for here. The candles are holding well above the 9-period EMA right until there's a break below the 9-period, but it didn't break the 20-period. So it could be a quite tricky sign to take note of, but it's worth to pay a bit more attention, because the next few candles we have a very long red bar that breaks both the lines. So it's just telling you that moving averages is also acting like a dynamic support and resistance for your prices as well. Now, DMI I mentioned earlier in the beginning of the slide. So DMI is a trend tool as well. It's important because the one of the key measurement for strength of the trend is what we call average directional index. So I mentioned earlier, once you identify where the trend is heading, we need to know whether is there still strength left in the trend. There's no point to participate in the trend when the trend is almost exhausted or peak. So you want to be participating when the trend is still very strong. The way to identify is to look at ADX value. So there are three major components of DMI. First one is a positive directional indicator, which measures the upward movement, negative directional indicator, which measures the downward movement, and ADX, which is a key one, measures the strength of the trend, regardless of any. So it can be a downtrend as long as ADX is rising in the downtrend market, is telling you that this downtrend market is strong. And uptrend market, if the ADX is continuing to rise, that means uptrend market is strong. But when ADX value starts to peak or starts to decrease, that's where you need to be very careful. Okay, now because of other components like the positive DI and minus DI, which is still part of DMI indicator, that's also quite useful in the sense that it works like a moving average crossover. So positive DI, if it crosses above the minus DI, technically it's like a bullish setup. And vice versa, if the minus DI crosses below, crosses above the positive DI, it's generally a negative setup. So the ADX is generally measuring the strength of, or rather the difference between the movement, the positive DI and the minus DI. So here, this is how we apply. You look at the bottom panel here. This is your DMI indicator. The red one is minus DI. The green one is positive DI. So you can see that whenever the negative DI crosses above the positive DI, generally that tells you the market is going to be a bearish signal coming in. So you can see that in terms of moving average crossovers. First of all, obviously you got Heiken Ashi candles that is trading below both the moving averages, and you got a bearish crossover on your moving averages. Now, this circle area here is also a similar thing. You have a positive DI crosses above the minus DI, which is also coinciding with your moving average bullish crossover. So the positive DI crossovers and the moving average crossovers, they are very similar. They give a very similar signal. So in a way, it's actually quite redundant. But DMI, like I said, is not mainly used for the DMI crossovers. It's actually mainly used for the ADX. So what we have here, the ADX now is basically you put the ADX line, which is the black line here. So I draw a blue line, which is a 25 value. ADX runs in value, always make sure. So it's like an RSI indicator where it runs from 0 to 100. So the key rule of thumb is that any value, ADX value that's above 25 is telling you the strength, that the strength of the trend is gaining momentum. Anything that is below 25 is just telling you the market has no direction, there's no trend. So like for example here, this particular downtrend actually is very strong because you look at the black line here, the ADX is rising. Right until where it starts to peak here, you can see that this particular trend, downtrend, is slowly losing its momentum. Same goes for here, this particular uptrend starts to gain momentum when ADX starts to cross above 25 and eventually the market peak quite fast. So it's useful to look at when ADX rises above 25, that's usually be something to watch out for. That means there's strength in the trend and usually it trends in that direction. Now, last bit, I think in every trading plan, you must have a way to make sure that, to set the stop loss and your profit target level accordingly. There's no point, you have all the plan in place, but you don't have a way to manage your risk. And the key thing about trading in this particular market, especially when markets are volatile, is always about managing risk. If you can't manage your risk well, generally, that means that you're over risking yourself, and that's not a good thing. So, average true range basically measures the range of the particular movement and how much the price actually fluctuates. So it's actually the true range of that particular period. So if ATR measures the true range for that. So when you have a high ATR, usually means high volatility. When you have low ATR, usually means low volatility. Now, let's put it all into a context of how to do a setup. So what we have here is that you can see candles are trading this red Heiken Ashi bars. They are quite long. The body bars are quite wide, and the candles are trading below both the moving averages. So generally, that tells you that this is a bearish crossover and it looks like it's a negative setup. The key thing is that ADX is slowly rising above 25, and the ATR value is at 4 at that point in time, 4 points for this particular period. So what you can do is that you can short at 16, the price is 1621.5, so ATR is at 4 points. So if you want to manage risk using ATR, what we usually do is that we look at the risk to reward ratio. So if your risk is 1 to 2 times of reward, that means you're willing to risk 4 points for 8 points of a reward. So therefore, that's how you set a target profit accordingly. So your target profit is set at 8 points. The stop loss level is set at 4 points above your entry level. So true enough, I think the market went lower. Now, a lot of argument is that because the market went way below your target profit, but if you look at there's many argument or there's many debate going, is that why not you just wait until when ADX starts to peak, or when Heiken actually starts to show you there's weaknesses. You can do that, but I think being a trader, you really need to be disciplined in your approach. If this is what preset, or this is what you have done on your preset condition for a trade, you should stick to it. So if that's how you really precondition your trades beforehand, once your target is reached, whether it's stop loss or target profit, you should be out of the market. Market is always there, it's always present. There's always opportunity that you can always look for the next best opportunity again. And then doesn't mean that if we miss this, it's going to be bad. But having said that, you have to be disciplined in your approach to make sure that you stick to your trading plan. Now, another trade example here, you can see that a lot of these candles, although they are small, but they are holding well above the moving averages, and moving averages tends to go up. What is interesting is that the ATR seems to be quite low, but the ADX is slowly creeping up above 25. So it's telling you that generally it's a slow upward trend momentum and slowly gaining momentum. So the ATR is low because the range are still very low, but it's an entry signal because your ADX value is above 25, and your candles are above the moving averages. So you can long at 1575, your ATR is 3 points, work risk to reward 1 to 2. So looking at 6 points for profit, 3 points for stop loss. Now, risk to reward ratio is very individual. 1 to 2 is very ideal. Sometimes, in reality, it's very hard for us to hit 1.2, 1 to 2 sometimes. In fact, as long as you have reward greater than your risk, and generally that's a profitable trade. There's no point putting 1 to 1. Generally that's not going to be good for trading on the longer term. So you always make sure that you have a reward higher than your risk. And if you are a big risk taker, obviously you aim for higher risk to reward ratio. So looking where we are today, you can see that market seems to despite we saw a sharp movement on Monday, but then it tends to taper down, and ADX is slowly back to 25 or slightly holding 25 or slightly below. The market is looking at a range at this particular point in time. So if you try to look at on daily basis, is there a particular trend forming? It's still too early to tell. Wait until when ADX starts to go above 25 or the candles are starting to break out from the moving averages, then probably you can get a clearer picture. So right now you can see that FKLI market in general is trading at quite a tight range, and it's actually heading sideways for now. So yeah, I'm just that's pretty much I'm going to cover on today's topic on how to trade FKLI. So importantly, I think is really looking at the end of the day, the factors that influence the market. When it comes to trading, it's very much less of that. It's really about how you actually plan your trades, how you navigate your trades, and trading is just one part. There's emotional involved as well. So it's about managing risk, managing emotions. These are all also very key and very important aspect of trading as well. So I just want to share a few quotes. Alexander Elder always mentioned, he's one of great trader. You can search his books. The goal of a successful trader is always to make the best trade. So it's about the processes at the end of the day. So as long as you get processes right, you stick to your process, the profitability eventually will come. And trading is not about making profit. A lot of people always assume when it comes to trading, it's all about making profit first. No, it's actually you have to learn how to take the losses first, because if you can't handle that well, or you can't learn that well, definitely you can't learn how to make money. So learn to take losses first is the most crucial step. So I'm just going to end here. Probably I hand it back to Chow Wei for any questions from the audience.
Okay, thank you, Mr. David, for this insightful sharing. I think the audience have also learned a lot from today's session. Okay, so now we will begin with the Q&A session. So if you guys have any questions, feel free to ask. I think Mr. David here will be very helpful in answering all your questions. Okay, Mr. David, we actually have a question here for you. So there's someone who asked, what is a realistic monthly return target for FKLI swing traders?
Wow, it's actually quite difficult to determine. I would say if you can aim like 4 to 6% is actually very good, given the fact that the market volatility is actually shrinking. So and in fact, look at where it is. It's actually still longer run is still quite a range market. So I can't really give a definite number, but I think in general that 4 to 6% is generally quite a good number. But if you expect something more, you can't expect it from FKLI. It's definitely a low volatility nature product.
Okay, thanks for answering that, Mr. David. We have another question over here. So I think we'll select this as the last one due to time constraint. Mr. David, here's someone asked that why have FKLI struggled to stay above 2006 to 2007 despite good earnings and GDP?
Well, I think one of the key thing is always this foreign shareholding that or foreign interest that's coming into the country. As long as we don't have that kind of allure that can attract foreign interest to come and invest in the market, we definitely not going to see strong performance in the KLCI because we need all this external party. We can't just we can't just hope for domestic driven investment. We really need the foreign players to come in as well. So if the foreign players are not coming in or staying out, watching closely, they're not participating in the market, there's generally that tells you there's not much going to be an upside for the market as well. So I think that's generally is a concern, a general concern naturally for the KLCI market.
Okay, I think that's pretty much it for the Q&A session. Thank you so much, Mr. David, for your time. So before we end off with today's webinar, just to share with you, if you guys have any issues, you can actually contact us over here. You can join our Telegram channel. So over here, we have updates and also recaps on the latest market movement, news release for big companies, and also market view for major indices, commodity, and also currency. Okay, so you can connect us to our social media. We have Facebook, YouTube, Telegram, Indeed, and also TikTok. You can also visit our social media and also our webpage over here. Okay, so thank you all for joining us. And thank you, Mr. David, for today's insightful sharing.
Yeah, thank you. Thank you, everyone.
Okay, thanks, everyone.
Thank you.
I guess we shall end the webinar for today. Thank you.